right, we'll go ahead and get started and continue to let people in. But good morning, everyone. I am Linda Knowlton, Florida Association of Mortgage Professionals, and here to welcome you to another wonderful Zoom with one of our favorite industry partners, Angel Oak. We have John Jimenod, who's the EVP of Production, and Scott Grubel. Do I butcher your name every time, Scott, or am I even close?
No, it's close. Grubel.
Grubel. Oh, yes. So much better. So, senior account executive. I wanted to ask both of you before we got started, remind us again how many years both of you have been with Angel Oak.
I've been 11, a little
I-
over 11.
Yep, and I just completed my 9-year anniversary.
Well,
That was
that's
back in August,
wonderful.
right?
Yeah, that's hard to say in our industry, and hard to say in the last few years in our industry, because I've seen so many shifts going on with individuals, companies, and all of that. So congratulations to both of you. But Angel Oak is one of FAMP's industry partners and empowerment sponsor for our convention, the Mortgage Revolution, that was just in August. And we're doing a little follow up from that as well. And it was so well attended and had some incredible feedback. And this is why we're having this today, to kind of go over some of the hits of that show, and also the questions and the products that were presented by Angel Oak. So, John, I am going to give you the floor, and I will continue to let people in as we keep going today. So, thank you both.
Thank you, Linda. Yeah, and it's a true partnership between FAMP and Angel Oak. So we're really proud to be one of the power sponsors, and really, getting to know you and everyone else on the board at FAMP has really been a true pleasure. So thank you. So again, I'm John Jimenod, EVP of Production here at Angel Oak Mortgage Solutions, and I'm here with the #1 AE in the country, Scott Grubel, and it's and we wanted to talk a little bit about today. Today we're going to talk about what we saw at the trade show, right? And then we're going to talk about what we discussed in our breakout session. And then Scott and I are going to really dive into really hot topics in Florida right now, specifically for Florida. And some of the process improvements we have, we're really excited about, and a little bit of marketing, and then, what really separates Angel Oak from everyone else in the industry. So we'll talk a little bit about that along the way. So Scott, anything to add there?
No, I think you nailed it right on the head. We have a kind of a little agenda laid out, but starting with what an amazing success and an amazing event the trade show was this year up in Orlando. We had an amazing time. The venue was phenomenal. A lot of fun. Great lazy river in the back of that hotel. And I saw a lot of people out there taking advantage of it. So it was cool to kind of, get out of the work environment a little bit and get to know people and speak to people in the industry, whether it's from, colleagues, account executives from other lenders, or loan originators, title companies, realtors, a little bit of everybody. So it was a lot of fun.
Yeah, I'm really, for the last year, I've been plugged in a lot of different, state associations, and I can honestly say this: I think Florida has the best. So if there's anyone from another state,
we like hearing it.
and Scott, you touched on the venue. Linda, it's going to be there next year too, right?
Yes, it'll be the next 2 years. We signed a 3-year contract last year. So we're excited about that. We've had some great feedback about the venue itself, location of the venue, and all the amenities that are there as well. So yes, expect that. We're not going to, next 2 years, that's where we'll be.
Yeah, if anybody's listening to this recording and did not make it out this year, you definitely want to get out there next year, because such a great spot, such a great location, connection of the JW Marriott with the Ritz-Carlton, and all the amenities that the two share together was just a lot of fun.
Yeah, you don't have to leave.
At the golf tournament. We had a great showing at the golf tournament too, so that was fun also. So great spots to go eat to. And I'll stop at that. So, but Scott, you know, we had great foot traffic at the show. Selfishly, I'm going to talk more about our breakout session, right? The room was packed. We had 50 minutes, I believe, and I'll throw one other shameless plug in there, Linda. We had all the account executives in the front of the room, and we had over 80 years of experience, 80 years of experience just at Angel Oak.
Wow.
Yes. That's
Wow.
not
That is
including all
impressive.
non-QM space and everything, like just at Angel Oak, over 80 years of experience in front of that room. And what made that breakout session so successful is the knowledge and the expertise that Scott, Stacy, Steve, and Andre, Oscar, Jerry, all of them have, and even Moses as a regional for the state of Florida, they have. It really made it successful. Scott, anything else? You know, I know we
Yeah,
have 50 minutes
absolutely.
going on forever.
Yeah, speaking in reference to the actual show itself, so much value I thought was brought to the table. So a lot of credit to FAMP. You guys really brought in a lot of great keynote speakers. You know, we had a great breakout session. Our room was packed, but we also attended a bunch of the other breakout sessions because there was just so much valuable information that we wanted to be able to absorb to be able to continue to expand our knowledge base in the industry, in the space, and see what's going on in everybody else's world. So, you know, again, when you come to these shows, in addition to being able to, you know, meet and greet a lot of people you may do business with every day, but never have a chance to meet them, and run into your colleagues and have great industry discussions, you get to learn so much and you have all this value being added in all of these breakout sessions. And you walk away feeling inspired. The energy was great in the room, in every room, but all weekend long, I just felt like the vibe, the energy was good. I felt a big feeling amongst everybody and all the attendees, that everybody kind of knows that you know, the industry has gone through a few rough years, but we've kind of leveled off here, and everybody's preparing for us to enter into this next cycle, which, you know, seems to look pretty good for us. So overall, it was just, I came out of it reinvigorated, you know, came out charged up. Grateful as always for this amazing, beautiful industry that we have the ability to work in every day and to serve people. And at the end of the day, we're all in one form or another. We have a hand in bringing somebody the dream of home ownership at the end of the day. And you kind of, you know, leave, you drive home, you reflect a little bit. Me, a 3-hour drive down to South Florida, and you think about how powerful and how informative and just, you know how good it was to be at the event. It's something that I think everybody should experience that's in the industry.
Thank
Yeah,
you.
Scott came up with this mantra. God, it's been about 7-8 months now, Scott, and it's the I get to, right? I get to put underserved borrowers into a home. I get to help build a community. Not I have to, I get to. So
Yeah.
that's our mantra.
Like
We've
that.
made t-shirts here at the company that do that, and so we went out and got them for everyone within the company and are giving them out on a daily, weekly, monthly basis. So we get to. So
I like that a lot.
yeah.
That's really good.
So the breakout session was great. Like I said, you know, we could have went on for hours, but we were all put on a time limit, and but we were able to get people we didn't get answers to questions for to come by the booth, and again, that drove a lot of traffic and a lot of more in-depth conversations. So
Yeah.
Scott, let's go into, you know, you were on a panel about 6-7 months ago, and we want to talk, you know, what's near and dear to Florida originators, right? So I'm going to share my screen. Let me know if you can see that.
There we go.
Okay, perfect.
Yep, all good.
So Scott, you know, we have all these great programs, but some of the things that you really know a lot, I mean, you know a lot about a lot, but well, my screens.
Well, I'm thankful that I get to see a lot of scenarios.
What do you
So
do?
with that brings a lot of experience. We like to call them reps here at Angel Oak. I have a lot of reps under my belt, and you gain a little experience when you do that. And kind of speaking to your point, John, as we get into the non-warrantable condos, speaking to your point about our breakout session, we could have probably gone on for another couple hours, right? uh, back to what we were saying about all of the value that was added. The non-QM space is ever changing. It's so dynamic, and so much has changed from last year to this year. And we had a lot of great interaction, a lot of great questions because people are curious as to how we're doing certain things. So, from last year to this year, we've added a whole suite of second lien products, right? The HELOC, bank statement HELOC, full doc HELOC. We've added closed-end second mortgages. We've added a DSCR, closed-end second mortgage. We've enhanced the DSCR program itself for first mortgages. We added the P&L program over the last 12 months or so. So much has been added. There was a lot of great conversation, a lot of great back and forth. We could have gone on probably for a couple more hours, right, to go into more of the details, but we have the opportunity to go into some of it now.
Yeah. So Scott, one of the big things in Florida, right, are non-warrantable condos, condo
Yep.
hotels. So much so that at Angel Oak, we've built, we have all our programs here, but we've built just a condo specific landing page to help everyone, everyone across the country, but specifically here in Florida. And Scott, let's talk about condos and non-warrantable and warrantable and so
Absolutely. And this topic obviously is one that FAMP knows a lot about, because we've had Orlando and we've had Rick from Kind Lending advocating, lobbying on behalf of the state, and the FAMP up in Tallahassee, because condos have been a very sensitive topic for a number of different reasons, and they've done a phenomenal job. So thank you very much on behalf of the whole industry in South Florida to those two gentlemen. But the fact of the matter is there is still a huge percentage of projects in the state, I think it's somewhere over 70% today, that are considered non-warrantable. They do not fit Fannie Freddie's guidelines. That number has fluctuated, but mostly increased over the last 3 or 4 years. We all know what happened in Surfside. We all know what that knee-jerk reaction was from the state, requiring all of these projects to, become up to date with all of these new inspections that were put in place, what kind of an effect that had on HOAs and their reserves and their reserve requirements, which then trickled down to the unit owners. And it made things difficult. We have been very active and very strong in lending to the non-warrantable condo market, and we continue to be. Non-warrantable condo can be non-warrantable for a number of different reasons. And unfortunately, what I see on a day-to-day basis is there are a lot of projects still that are on the approved Fannie Freddie list that maybe are not warrantable once you dive into the details, and it'll end up coming out in underwriting. And I get that phone call, hey, Scott, this was on our approved list. We submitted it in, underwriting got a hold of, maybe it was the insurance, or maybe something new popped up on a litigation. Condo data changes on a month-to-month basis. So what was approved last month may not be approved this month. And we see that.
Sorry, so that is such, there's no truer statement than that. It does change month to month. So
Clearly.
yeah, that's critical, especially with that non-warrantable condo or even warrantable, like you said.
Exactly. It's critical to understand. And that's why the condo questionnaire gives us the data that we need. So the biggest, things that we're seeing today, that I'm seeing on a day-to-day basis that are causing these projects to be non-warrantable is obviously the insurance issue, right? So for insurance, with Angel Oak on our non-warrantable condo side, we can go up to a 10% deductible for hazard insurance. We can go up to a 15% deductible for windstorm, whereas Fannie Freddie requirements are 5%. We see a lot of insurance policies, master policies that are coming in at those higher deductibles because obviously the HOAs are trying to find ways to reduce that insurance cost. We're very flexible when it comes to items such as co-insurance, as long as there's full replacement cost value in the policy. The other thing we're seeing is some of the HOAs have begun to lower their quote unquote minimum insurance requirements. So they no longer meet Fannie and Freddie's minimum insurance requirements. Ours are much more lenient. So we review those case by case, but most of the time we're able to lend on those. Those are the biggest ones we see. We do see some ACV coming around on roofs. And sometimes they'll put it, you know, a little clause in there. It says ACV on roofs that are over X amount of years old. Unfortunately, anytime there's ACV, we're not able to lend. It does need to be replacement cost value on those roofs. The second item that we see a lot is obviously the inspections. And there are still a lot of projects out there that are trying to get up to date with their inspections. So they have a lot of ongoing construction or work going on in the project. The Fannie Freddie Form 1076 questionnaire, or even the limited questionnaire, they are going to direct questions directly at that. Whereas on our non-warrantable condo questionnaire, we don't ask about any repairs, we don't ask about any of the inspections. Those are not a factor in us making our decision on being able to lend into that project or not. You know, we talk about reserves. From a reserve standpoint, on Fannie and Freddie, you need to look at the current year's budget and use what's being collected on that budget to determine if you're going to go full review or limited review. In the non-warrantable space, we do look at the current year's budget, but we also will take whatever the current balance is in the reserve account for that project, and we will add that to what they're collecting in the current year's budget. And that's how we arrive at our percentage of reserves divided by the operating income. So
Scotty, sorry, so how many deals do you think you saved just on that?
at least 3 a month. At least 3 a month, we're all going to call and say, hey, we need to go higher LTV on this. We don't have enough on the reserves. We have, you know, 5% on the current year's budget. And that first question I ask is, okay, do we know what their current balance is in the reserve account? No, we don't. Let's find out. We end up finding that they have a nice chunk of change sitting there, which is why they're not collecting as much in the current year's budget. And we add those two together. Next thing you know, we have 10% reserves and we can take that borrower to 90% LTV. So at least 3 loans a month I'm saving just with that feature alone, not even talking about the insurance, the litigations, the inspections, and everything else that we just went over. Mhm.
But what would that mean to an originator, just saving, you know, yeah, you're getting 3 deals, but what if they save 3 deals even in a year? You know, what does that mean to their top line and bottom line?
Well, I'll take that a step further, John. I've had a lot of originators that were able to save a deal in a particular project and were smart enough to speak to the right, you know, people and end up becoming a, you know, preferred lender for that project because they were able to deliver and close a loan in that project where others were not able to close because they found the option of our non-warrantable condo program. So
That's brilliant.
very impactful.
So Scott, let's talk a little bit about, you know, we have some highlights here: purchase rate, turn, cash out. The biggest thing I like about our non-warrantable condo program is we don't think an LTV. The borrower qualifies for a single family at a 90% LTV using bank statements. They qualify for a condo. 90% LTV using bank statements. So, and then, you know, here it's kind of small type, but new construction, depending upon how much is sold and closed, you know, if it's 90% sold and closed, we'll max LTV. Obviously, if it's 25 to 89%, it's a 10% reduction in LTV. So if it's just brand new construction with less than 25, they're not eligible. So.
Right, which we're seeing a lot of new construction projects in South Florida, especially down in Brickell, Miami. You see a lot on the coastline in Broward County and Palm Beach County. So we are doing, a lot of them are high-end buildings as well. So you're talking about big loan amounts. So a lot of times the HOA might not be turned over yet, still in control of the builder. We're okay with that on non-warrantable. They typically have some pretty strong reserves, but a lot of times you'll see a high amount of investor concentration in those buildings, right? Which we can go up to 100% investor concentration as long as no individual or entity owns more than 20%, not counting the builder. So new construction projects, if the builder is still in control of more than 20% of those units, for us, we can still lend there. Whereas, you know, conventionally, sometimes that's an issue. But going back to your point, John, it's a really important point is, and I like to explain it this way, for us, non-warrantable condos is a property type. It's not a program. It's not a product, okay? So Under the bank statement program, you can do non-warrantable condos. Under the DSCR program, you can do non-warrantable condos. Under our full doc, under our asset qualifier, et cetera, you can do a non-warrantable condo. The only program we offer today where we don't offer a non-warrantable condo is the HELOC. That's the only product as of today. But on all of our other products, you can do a non-warrantable condo. The LTV will be dictated by the borrower's credit score, as always, and the amount of reserves that the project has. Hence the conversation we just had. If we're able to increase the reserve amount by using the calculation that we utilize, we can usually get those borrowers higher loan to values.
Scott, there's another thing here about HOA reserves, less than 70%, no reserves required.
Correct. Yeah. If the LTV is 70% or below, no reserves are required in that project at all.
Yeah, that's pretty good too. So, anything else, Scott, off the top of your head? You hit on the 100% concentration. You must have saw my eyes were looking right at that because that's where I was going to go. But again, you're so thorough in everything you do with regards to all projects.
Yeah, I think two more important parts to non-warrantable condos. The first is short-term rentals are allowed. We're okay with buildings that permit short-term rentals in the building. In some programs like the DSCR, we can even use the short-term rental income if it's an investment property to qualify. So that's okay. And then condo hotels. We do lend on condo hotels, primarily more of your vacation rental type properties as opposed to, say, the W hotel that happens to have a little residency building. But we are able to lend on condo hotels as well. And John, if you want to click on the questionnaire tab there at the top, I think it'd be a good idea to kind of just show what our non-warrantable questionnaire looks like.
I just clicked on the answer key, so
So I like to always show this because it really shows you how simple it is. You have 2 pages here. The first questions 1 through 10 are just basically your project and unit information section. That's basic. How many units are in the project? Was it a conversion? Is there an HOA in place, etc. Number 11 asks if they have any hotel, motel activities, deed restrictions. Is it a manufactured home? Standard questioning. And then on page 2 is a little bit more of the important data here is at the top. If you notice, we're asking about delinquencies, but we're only concerned with delinquencies that are over 60 days. I like to point that out because, as you guys know, in the conventional space, you're looking at 30s, 60, 90s, etc. We're only looking at 60 and over. And then you'll see in number 2, we're asking the individual from the HOA completing this form or the management company to tell us what the current income is, operating income, and what the reserves are. And you'll notice question number 3, that's what I was pointing to earlier. Does the homeowners association have a reserve fund separate from the operating account? If yes, what is the amount in the fund? So we're going to add that line to the reserves line and divide by the income line, and that's how we reach our reserve requirement. One other thing I want to point out, when it comes to non-warrantable condos, the only piece of documentation we require is this questionnaire. We're not asking for the budget. We're not asking for the condo docs. We're not asking for the reserve study. We're not asking for anything else other than this condo questionnaire completed by the HOA.
Yes, Scott, I had a question I wanted to ask about. If it comes to me, I'll think about it. So
I have a quick question.
sure.
So Scott, if only the questionnaire you say has to be completed, what if the questionnaire is not completed in its entirety?
Then we usually will ask that they go back and answer any particular questions that were not answered. But you bring up a good point, Linda, because we do see a lot of these management companies that are being hired by the HOAs, and there are certain questions they won't answer. So they'll give us a cover sheet, and it says in reference to question number 4, whatever their feedback is on it. We can accept that reference sheet if it gives us the data that we need. In some cases, if it's something that we really do need answered, we might have to condition back to have somebody from the HOA have that answered, and we usually are able to get that done.
Okay, got it.
Mm-hmm.
Yeah, Scott, I remember the question now was litigation, right? Where structural litigation, it usually will look at, but if it's not completed, it's going to be pretty difficult to close that loan, but if it's slip and fall, we're okay as long as they have the reserves to cover the.
Exactly right. Exactly right. Structural or safety litigations, industry standard. Nobody's lending on those properties, unfortunately. But anything else, if there was a dispute, a slip and fall, something along those lines, we usually have no issues with those litigations. We do ask for a copy of the complaint. We don't, by the way, we don't need an attorney opinion letter. We know those can cost money sometimes for the borrower. We just need a copy of the complaint, which we can usually get from the HOA, and we can review the complaint and make a determination.
Yeah.
Mhm.
Again, just different ways to help everyone close more loans. Scott, let's go look at, we talked about HELOCs, right?
Yeah.
Everyone's got their opinions what the Fed's gonna do, but let's face it, if the Fed, even if they lowered a quarter, what is it? We were talking about this a little bit yesterday, Scott, like 85% of the mortgages out there have a rate of 6% or less.
Yeah.
63% have less than 4. So
Yep.
but there's still so much equity in homes. Since 2019, homes have appreciated almost 50%. There's 35. I was at a conference earlier this week, and there's like $35 trillion worth of equity in homes.
Mhm.
And I know we've seen Florida probably increase even more than that 50% since 2019. So there's a ton of equity in homes in Florida, and for the fastest growing segment of the workforce, which are self-employed borrowers, we have a bank statement HELOC for self-employed borrowers.
Yep. This, in my opinion, is going to be the biggest opportunity going into the next, 2 years, I think.
I
Um,
agree.
because of exactly what you just said. You have so many people out there that have what we like to call generational interest rates on that first mortgage. They're not going to touch it, but they want to tap into the equity, pay down some high interest debt, maybe expand a business, etc., maybe renovate the property. How do they do that? If they were a borrower who borrowed initially using a bank statement program or using a DSCR program, right? Our HELOCs are geared towards the non-QM borrower. So this bank statement HELOC allows them to qualify for a home equity line of credit or a second mortgage in the same exact manner that they qualified when they purchased the property originally and took out that first mortgage, using their bank statements for income versus the tax returns. It's unique to the marketplace, and it serves a huge underserved market in all of those self-employed borrowers who, let's face it, they did a bank statement loan on their first mortgage because at the time they were not reporting enough income to their tax returns. They're probably doing the same thing today. So anybody that's closed a bank statement loan in the last 4 or 5 years, I'd be reaching out to those customers and saying, hey, you have all this untapped equity in your property. If you want to tap into it for whatever reason you might have, we have a product here that can help you do it. And by the way, we don't have to touch that first mortgage you have at 4%, 5%, whatever the case may be. To your point, John, and if you remember Linda, in our opening ceremonies, Logan from Housing Wire put an amazing presentation together and kind of just laid out all of the data and showing where we are headed from an interest rate standpoint. John and I were having this conversation yesterday. If the Fed begins to cut rates at the pace we think they will, let's be conservative. Maybe it's a quarter for the next few cuts, right? Remember that HELOCs are priced off of the Wall Street Journal prime rate, which is directly affected by those rate cuts instantly. So you can literally see as every cut goes into place, HELOC second lien pricing is going to drop. It's probably going to lead the way, I would say, in terms of seeing the speed in which the rate is going to drop versus your ARMs or your 30-year fix, et cetera. And it's going to open up this huge opportunity, in my opinion, where I've priced a few HELOCs this week, some lower CLTVs, of course, but I've priced a few HELOCs this week where we're at like 8%, 8.5%, maybe 9%. That's pretty strong for a second lien product. But if you see a few rate cuts, we could be looking at HELOCs in the 7s, maybe 6s. So I think this is going to be a huge opportunity for originators over the next couple of years.
Yeah, Scott. So obviously bank statements and if anyone's really been on any of our bank statement, we calculate the income the same way
Mhm.
You're gonna send Scott a 1003 credit report or any of the other town executives in Florida. 1003 credit report and then the bank statements and, I'll do my public service announcement, send us 24.
Yeah.
Yes, the easy way is just to go to last 12, but send us 24. Scott and all the other county executives, they'll tell you which way you should go. And
You,
yeah.
sorry, John.
Oh, you're
You,
good.
you can see on here that the program goes up to a CLTV of 90%. So remember, your standard cash out refi is at 80%, but on a HELOC, you can actually go up to a CLTV of 90% on that property. So they can tap into a little bit more equity using the HELOC program on top of the first mortgage. The loan amounts go up to 750,000. So you can see a pretty good amount of their equity can be tapped into. We think as the program continues to grow, we'll probably see those loan amounts start to get bumped up a little bit. We can do these on primaries, second homes, and investment properties. So you don't have to just strictly look at a primary. We have a full doc option available. The way the HELOCs work, I mentioned it's based on the prime rate. The borrower does lock in a margin today, and then their rate every month will be the prime rate, whatever it is, plus that margin. It's an interest only payment for usually the first 5 years on a bank statement HELOC. It's a 20-year term with a 5-year interest only draw period, followed by a 15-year repayment phase. So it's, ton of flexibility on this product. And then again, we have the closed end second mortgage for those that don't necessarily want a line of credit and maybe they just want their cash in hand. They want terms of 10 years or 15 years or 20 years or 30 years. We have that product available, qualifying the same way with the bank statements, like you mentioned, John.
Yeah, Scott, and we'll talk a little bit about marketing tools that we have for the originator out there, but you said it and said it well. If anybody who's closed a bank statement loan, since I think you said 2018, 19, 20, 21, really, this is that person. I would be, if I was an originator, be marketing through my database of self-employed borrowers that I've closed. And even if you like Scott said, maybe someone is deciding to file their taxes, but maybe they didn't do it last year. Anything like that. We're not looking if they filed their taxes either. So I think that's a benefit also. But again, this is across the board on all programs. So let's talk about something we just launched. Unless you've got anything else to add regarding bank statement HELOCs.
No, I think we covered it pretty well.
Yeah. Where is? You know what, Scott? Is it not up here yet? There it is, sorry. No, that's the close end, sorry. It's so new, I don't think we have that program up here yet, Scott.
Is that the DSCR?
The DSCR, yeah.
Yep, a DSCR closed end second mortgage. I mean, we could probably use this screen here to discuss it.
Yeah.
Because most of the highlights are going to be listed here. Few little differences, but we rolled out a closed-end second mortgage that is qualified using DSCR guidelines. So anybody who, again, investors who purchased an investment property using the DSCR program, they can now tap into the equity in that property, which there will be usually, a lot of, if you think about it, DSCR LTV's max is 80%. So going into those loans, those people put 20% down, right? Today we actually go up to 85, but that just came on board maybe a year and a half ago. So most of these loans that are in place were done at 80% LTV, and obviously we've had equity built on since then. So there is equity in these properties. These borrowers can tap into that equity using a DSCR ratio. So no income verification, no employment verification, no rate, no DTI, just like you would see on a normal DSCR loan. You do need a 700 credit score to qualify for those. It's going to be a fixed rate and a fixed payment. So it's a straight closed-end second. The borrower will receive all of their cash at the closing table, but they can select from a different number of terms, 10, 15, 20, or 30 years. So again, just another option for borrowers to be able to tap into equity. What we're seeing is borrowers who have utilized this program, it just came out, but we have had a few go through the pipeline. And the borrowers using this program, what they're doing is they're taking that equity, and in most cases, they're buying more investment properties. They're using the leverage in that property that is already cash flowing, and they're using that leverage to go acquire and expand their portfolios. So there's a lot of benefit in that program, a lot.
Scott, we even see it not just for the DSCR second lien, closed-end second lien, we're even seeing investors taking cash out,
Yep,
doing it on a first lien, and most of them are doing them in multi-packs.
Yep.
So really looking to broaden your business for the rest of the year into 2026. I would go back to that database, and anyone you close an investment property for, this is a great way to market yourself and get yourself back in front of that borrower. And maybe they're looking to do cash out to buy more investment properties. Now you're not only satisfying that borrower's need, but you're also saying, go work with this referral source that I have, and you're, strengthening that relationship with your referral source.
That's right. And common question we get asked a lot on these, John, is if the borrower owns the property in an entity, in an LLC, which we have seen most of the time, investors do when they purchase using DSCR, can they keep the entity, keep the property in the LLC on the closed-end second mortgage? And the answer to that is yes, we can do that.
So Scott, one thing I wanted to run down when we talked about condos, short-term rentals, and is the use, you mentioned it, the use of, but how we use AirDNA and use it up front at the prequal stage to get that, and there's no haircut on it, to get that rental income for that year. There's no, we don't take 75%, we take out whatever that revenue is, divide it by 12, and that's the income we're going to give that borrower for that rental. So, and that's done at the prequal stage, which was another thing we wanted to talk about that I think that separates Angel Oak from a lot of our competitors out there. We do that prequal up front. Scott, all the account executives across the country take great pride in doing that prequal, that pre-underwrite, the 1003, the credit report, the bank statements in. If it's a debt service coverage ratio, they're looking at Zillow or the short-term rental. And if they are not 100% sure putting their name on that, we have a help desk that will help them. And if it's an exception, we get that exception up front. All those things are done before you even probably, your borrower's out there shopping. So we understand how those referral sources are so valuable, especially these days. And we respect that relationship, and we take great pride in doing that prequal up front. And we'll even do prequals on TBDs. So it's just, I think it's definitely one of the things that separates us from everyone else. Scott, anything to add on that?
Yeah, 100%, John. One of the things we talk about a lot here at Angel Oak is being able to deliver surety of execution to our clients. We want our clients to be able to trust that when they send a loan to Angel Oak, that loan is going to close. And if it doesn't, it's because of factors that were out of everybody's control, the LO's control, our control, et cetera. We will pound on our chest a little bit here and, talk about our industry leading conversion ratios. I can speak for my personal conversion ratio is hovering somewhere around 77 to 79%. I believe as a company, John, where were we averaging recently?
About 75 to 76, Scotty.
Yeah,
So
yeah.
that's our pull through from the time a loan gets submitted to close. We're pulling through in the mid to high 70%. That's impressive.
Industry standard falls somewhere in the 60 range right now, just to give everybody an idea. Why? So why are we converting at a higher level? I believe it's directly related to what you just mentioned, John. If you think of it as a loan originator from the conventional space, if everybody was just submitting loans conventionally without ever running it through DU or LP and getting an approved eligible or even an approved with caution, right? How many loans would start falling out? There's a reason why the AUS was developed. Our pre-approval is our version of AUS. It's our version of DU. It's our version of LP. When I send back my pre-approval and it says approved eligible on the top, that means I've reviewed the credit. I've reviewed the 1003. I've reviewed the income. I've addressed any potential concerns with the loan originator. We have structured that loan properly to be able to submit that loan to underwriting and ensure it is going to get approved at an extremely high level. Again, can things happen that are out of my control, the loan officer's control? Of course. There could always be a random bankruptcy that pops up on fraud guard that the borrower never told anybody about, right? Those things happen in real life. But the reality is we're converting at a high level because we're reviewing all of that documentation up front. It's something that at Angel Oak we lean into because for some reason we have seen our space on the non-QM side. A lot of our competitors have kind of gotten away from that. We lean into it. We take pride in it, and I hope loan originators can feel comfortable knowing, wow, if I submit a loan over there to those guys, obviously based on the sheer data, there's a very high likelihood that loan's going to close.
Yeah, so Scott, so we covered condos, we covered second liens. One of the things I did want to share here too is, some of the great tools that we have here, right? This is a blended rate calculator for you. So you just plug and play some of your information in here, and it's going to help you have that conversation with that borrower. Say, hey, yeah, you have that 3% rate on your first. Here's Scott, what were some of the rates you said you saw? Granted, they were lower CLTVs, but
8.5, 8.99, 9
and it's
change.
going to give you that blended rate. So now you are a trusted advisor to that borrower. Say, hey, you have credit card debt out there, you want to pay that off, you want to fix up your house, you want to sell it. This is going to give you the power to have that conversation with that borrower and be able to easily coach them through the process. So, Scott, let's talk a little bit about, when you talk about pricing, our quick quote tool we have here, and this will roll into how to submit a prequal, and then we'll touch on market. And I know we're about 45 minutes almost into this, so.
Okay. Yeah, so our quick qual this is our online pricing engine. I think it's the most underutilized tool in the space because we don't require credentials to access it. I get the email all the time. Hey, Scott, I want to price a loan, but I need credentials. Nope, you don't. Go right to our homepage. We have no shame in our game, nothing to hide. You can go right into our non-QM quick quote, and you can see everything is simple click drop down items that you can select the details of your scenario from. And once you enter in all of your scenario details, you'll see pricing will begin to populate down at the bottom. As you continue to go up and make edits, you'll see that the pricing will adjust. So if you hit that view rates button, you'll see that we offer the full pricing table. So if you wanted to see your par rate versus, potential buy down rate or any rates that pay a credit back to your customer, all of those options are here and available to you. And you can run this on any scenario you like. Highly recommend loan originators hop in here because you could say, quote, within a couple of clicks, you can say, to your customer, if you put 10% down, here's your pricing. 15% down, here's your pricing. 20%, here's your pricing. If you decide to waive escrows, here's what it looks like. Oh, if you wanted to add interest only, here's what your rate would be. A lot of powerful data at just a few clicks away at the tip of your fingers.
It's got Jerry Calderon, who's in the Tampa St. Pete area, has a 9-year-old daughter, and she runs scenarios. And he says everyone passes. So
Yeah.
funny. But Scott, so if I click on 6.249 and I select that, am I locking the loan at this time?
Nope, not locking the loan. This is the process to submit one of those pre-approvals we just discussed to your AE. So you would click on a rate, obviously, to select which rate you want us to use for the pre-approval purposes. Step 2 will ask you if you want to add a MISMO 3.4 file, but it's not required. So if you don't have it buttoned up, you can hit next. And then in this page here, you're going to add some general information. Obviously, select your account executive name from the dropdown. And then you'll add your company information and your personal contact details. And then in these boxes below, you can literally drag and drop or click and upload as many files as you need to. So in this case, it's a bank statement loan. You would add your credit report, your 1003. You can drop up to 24 or more bank statements in this box. We have a business questionnaire that we quote unquote business narrative form that you can click on this blue link here to access and complete right up front. And then you'll answer a couple of questions here on credit history just to make sure there were never any bankruptcies or foreclosures or anything along those lines. And then hit submit. Once you submit, that will instantly notify your account executive that you have submitted a pre-approval request. In the case of a bank statement loan, it instantly puts the loan into our queue to be able to have the income calculated right away by our income calculation software. So we get a full broken down Excel spreadsheet calculated showing all the deposits line by line, month by month, and we're able to provide an income calculation to your borrower and therefore provide a pre-approval to your borrower.
Yeah, Scott, I heard the turn times right now from the technology for calculating the bank statements is coming back pretty quickly.
It's really within hours. You know, if we upload one of these in the morning, say, or anytime before 3 p.m., we're typically getting those income calculations back same day. And that allows the AE to be able to pre-approve, assuming income comes back looking good and we don't have to structure much there, we can get a pre-approval back to you same day. If we have to structure it, have a few conversations, maybe it's 24 hours. But yeah, the income calculation software AI today makes things a lot quicker.
Yeah, and we know how important it is to get, you know, those borrowers off the street. So we're keenly aware of those and want to work with you to get that done. So that's the pre-qual process. So Scott, I'm going to log into just some of the marketing here. So
Okay.
you talk about some of the enhancements we've made, not program wise, because we continue to do that day in, day out, but some of the enhancements we've just recently rolled out and are looking to make, you know, not just loan officers' lives easier, but your life and everyone else at Angel Oak easier.
Mm-hmm. We are continuing to focus on technology as an organization and leverage technology to make our process faster, simpler, friendlier, and more efficient for the user, for the loan originator, and obviously for the borrower. We want to increase the speed in which we can take that entire loan process from start to finish. So we're continuing to develop more different technologies. What we rolled out, something that's pretty commonplace in the agency space, but not so much in the non-QM world. I believe we were one of the first non-QM lenders to really offer this, is the ability to log into our portal, register your loan, float or lock your rate, and actually send disclosures directly to your customer. You don't need to wait or rely on us as a lender to send those disclosures. You can self-disclose instantly, fill out your fees, and disclose instantly to your customer the way you would today in the conventional space.
That's huge.
Huge. It was a huge step for us. Your borrower signs those. The reasons it's huge is because, let's say your borrower signs those disclosures shortly after receiving them. If you can literally submit your loan to underwriting and have it in our underwriting queue 5 minutes later. So, you know, realistically speaking, it takes about 10 to 15 minutes to register a loan, lock or float, request disclosures. If your borrower signs disclosures right away, within an hour, you can have that loan submitted to underwriting and in our underwriting queue. And we're currently running, depending on the day and the volume, 24 to 48 hours in underwriting for initial underwrite decision. So you're going from registration to underwriting approval in your hand, typically in potentially a 48-hour time frame.
Yeah, that's and you're going to continue to see technology enhancements, you know, even at the upfront, at the pre-qual stage, and all the way through to underwriting and closing. It's really, and it's not really, it's AI is involved, but it's really technology and efficiencies that we're just trying to bring to the non-QM space to make everyone's experience, you know, top notch. So Scott, I know you've been doing a lot of talking. I'll take over, jump in here, but you know, this is, you know, we talk, our homepage has an underserved borrower. I really believe this part of our portal is an underutilized part, and I get a little uncomfortable because if I was a loan originator, I would have a marketing plan for the next year and a half based on all the information we have here. So we have, and Scott, jump in at time, we have flyers already made for you. So we talked about the bank statement HELOC here. It's just a matter of clicking on, making a few clicks, filling out your information here, and it's has nothing, doesn't say anything about Angel Oak. It's all about you, your contact information, your NMLS number, your disclosures, your company, your picture, your logo, everything. It's just you. And you do it once on any of these, it populates all of the flyers. So I think we have 30 flyers out there.
Yep.
So that could be 30 weeks of, what does it cost, Scotty, to use this?
Let me see. Free?
Oh, okay. Yeah, thank you.
You
So-
just need to be an approved Angel Oak partner with credentials to our portal.
And that's it. So you could have 30 weeks of a marketing campaign here that you could just send out via email, do a screen grab of this, and it's just nothing about Angel Oak. Our marketing department works really, really hard at making your life a lot easier so you can market yourself and spend time building those relationships. So again, this is a list of all the, but we have them all for, let me see if I can get back to it. We also have social media posts. So we have them for LinkedIn, for our most popular programs. And we have the content already delivered for you. Did you know stuff that you can post? Asset qualifier for realtors. We have these directed towards borrowers. We already have the content for you. We have the imaging, we have the content, whether it's towards realtors or borrowers, bank statement borrowers. We have those for Instagram and Pinterest or Facebook and LinkedIn. Just have to download it and upload it to that platform you market yourself on. So we have all of these here for you. Cash out, HELOCs, investor cash flow, which we call internally, that's our debt service coverage ratio. This is all, I mean, I'm halfway done scrolling. I can scroll some more, but this is all built for you to market yourself. And then the last but not least, we also have some whiteboard videos, which are cute. I like them. And then we have this, I think, Scott, I'll let you take over on this because you do this a lot. Hold on.
Presentations, yeah. So, you know, again, this is a free tool to any approved originator, but any originators that wanted to put together a presentation, whether it be to realtors or borrowers or any referral source, we offer two different PowerPoint decks that you can use, a short form and a long form. They are 100% customizable, white label. So your name, your logo, you can customize your colors on there. You can even start to add in any of your own products and programs, whether that be Hometown Heroes or down payment assistance or anything else you want to discuss, you can add them to the deck. I highly recommend anybody out there that has access to our portal to download that presentation, invest the 30 minutes it's going to take you to customize it, because once it's complete, you can literally take that deck and present anywhere you like about non-QM as if you were a non-QM expert. We have a flyer here that allows you to, you know, if you wanted to set up an event, you can use this flyer to promote it, email it out to your database to try to, you know, get as many people in the door as possible. I have, what I do is I try to get a lot of my accounts to tap into this, and a lot of them have. And what they've done is they've customized it, they've invested the time, they put together beautiful presentations. It looks like it's fully branded from their company, but it's all of the data we gave them for non-QM. And they share it with every loan originator in the company, and everybody's out there presenting. And what I'm happy to do, and any AE within the organization will do for you, is I usually go along with them on those presentations as one of their investors, one of their partners, whatever you want to call us. And I'll help them present on their behalf. I'll jump in and, you know, help them with the presentation and talk about the products and programs in a little bit more detail. I can tell you this, my experience has been, and this is coming straight from my LOs, one of the best ways to pack a room with realtors is to talk about non-QM products and programs. They know about Fannie Freddie, DPA, Hometown Heroes, right? But they don't know a lot about DSCR. They don't know a lot about bank statement, P&L, 1099 programs. They don't know a lot about, you know, HELOCs that can help their homeowners tap into equity to buy more properties. Those are the things that really pique their interest.
Yeah, Scott, we always use this statistic. You get 12 realtors in a room, and one of them is going to close a loan with you.
That's right.
9% of the loans we close here at Angel Oak
Realtors
are realtors under the bank statement umbrella.
They're self-employed. They're self-employed.
Exactly. And Scott, we don't know how many actually close a DSCR with us because there's no job and no income on that 10-3. So we don't have that stat, which I think is probably even higher than that. So, and Scott, you've done a lot with social media. I've seen you post, you've done these presentations, you've done condo specific realtor presentations. So this is a powerful presentation. If you're not using this, you are losing market share. That's all I'll tell you. But yeah, it's a powerful presentation. And then having someone like Scott in the room who doesn't say anything about Angel Oak, just says he's one of your investors, is also, you know, just as powerful, if not more. Like I said, he doesn't say anything about Angel Oak. He's just one of your investors. So if you want to take advantage of it, and you know, you have Scott, you have Stacy, Steve, Jerry, Andre, Oscar, you know, you have all these great account executives who are chomping at the bit to do presentations like this. So, and Scott, again, you're great on social media. We have a lot of these social media posts. I suggest you start using them. And Scott, we've seen it. Go back to the booth, right? This is where I'll go back to the booth. People who Scott has closed loans with, who unfortunately hadn't had a chance to meet him, walked up to the booth and knew who he was right away because all the posts he makes and the value that he brings, there were 3 or 4 people deep waiting to talk to Scott. So it's kind of funny. I'm like, how did they were, it's fucking this social media post. So I know, Linda, we're near the top of the hour, but really just this
A
was
lot of
fun.
information you guys presented. It's some great information. And you know, if the loan originators need resources like this, and it's amazing that companies like yours and Angel Oak can provide that for us. So thank
Yeah,
you.
absolutely.
Thank
And we started this call a little bit about Scott talking about condos and you know what Orlando and other people are doing on this industry's behalf, right? So when your industry reaches out to you, any of you, and you know, is asking for, you know, maybe a donation for the political action PAC committees, right? You know,
Right.
it's this is what they're working hard behind the scenes. This is what FAMP does for you. So that's, you know, again, Linda, we love this partnership with FAMP. And thank you all for joining us, but Linda, I'll let you close it if.
Absolutely. We thank everyone for being on here. We will have the recording available for you. Maybe Scott, if you want to put quickly in the chat box your contact information, if anyone would like to have that.
Sure thing.
And so, but again, can't say enough great things about Angel Oak and all that you do with us with FAMP, but really all that you do for this industry and for the, you know, for the loan originator and obviously the home buyer. There's so many opportunities and products that allow someone to obtain a home through their own personal situation. And, you know, no loan is ever alike, right? No
No,
borrower is ever alike.
and Linda, Florida is the #1 state for self-employed borrowers, or for new business applications, I should say. But so
Yeah, I know it. We have a lot of people that moved to Florida these past few years, and I think will be continuing coming in. And they set up their
Yes.
own business because there are opportunities in Florida for the self-employed borrower that you do not see anyplace else. So just the cost of living, as well as if you're a chef or you want to own a boutique or anything like that, the cost of commercial space is much more affordable in Florida, and a lot of people come here. So,
yeah,
but again, thank you both for being here today. Thank you all for attending, and we will see you again soon. So thank you all.
thank you,
Thank you for
everyone.
having us, Linda. Appreciate it.
You're welcome. Bye bye.